Good evening, everyone. Today, we are launching a new daily live sessions, a new program. We are doing this for continuously 21 days, where we are trying to bring a new habit of learning. Every day evening, 5 p.m. CST, we are coming live and talking about a new topic for around 10 minutes. Make it shorter. We are making it trying to make it shorter, but we are trying to share the knowledge with this community. Till end of this year, till December 31st, you are going to learn every day one new topic. These new learnings, once you practice anything for 21 days, it can become a habit, and you can build that habit of learning every day for 10 minutes. And today, let's talk about a very interesting topic about stock. So, throughout the year, you work so hard to earn money. And one of our very common practice, what we all do is we invest money either in the stock market or in the real estate. If you have done some good investments in the stock portfolio, then let's talk about today on last minute year end tax strategies. So, what I'm going to talk today, I'll start with the basics and go with the big picture and coming up with the tax planning strategies at very high level. If you need more, then of course you can always reach out to us for one-on-one consultation. In at very high level, when we talk about whenever we do invest in stock, when you sell the stock, you have two things. It could be long-term capital gain, or it could be short-term capital gain. Of course, it could be losses also. We have a different tax rates for long-term capitals and short-term capital. So if it is a long-term capital, the tax rate, the highest can be up to 40.8%, including net investment taxes also, but which is 37% plus 3.8. But if it is a short term, but if it's a long term, it can be up to 23.8%, 20% plus 3.8%. But whenever you're selling your stock portfolio, if you can ensure that you are selling the stock after holding for at least for 1 year, then it is considered as a long term capital, and the tax rate is much lower than short term capital tax rate. If I compare this 40.8 and 23.8, the difference is 71.4%. That means you are paying higher taxes by 71.4% if it is a short term. So it's very important whenever you are selling your stock, just check, are you selling the LIFO, last as a FIFO, first in, first out? Because if you're selling the old stocks first, it could be the long term. If you're trying to sell the latest stock, when you're selling it, you need to pick the which stock you are going to sell. If you're selling the latest one, you might be ending up with short term capital gains. So it's very important how you plan this game. And sometimes, if you're based on your income levels, the short term, the long term capital gain, even it could be 0%, 15%, or 23%. It's all about what income level you are. So at very high level, if I look into that, so apart from the everyone think long-term capital gain is either 15% or 20%, but there is one something else called NIIT, net investment tax also. If the total you need to pay on top of this, these 15% or 20%. So it's very important to know. And whenever you are selling some stock, and if you're getting any losses, if you're booking some capital losses, these losses can be adjusted with your capital gains. It could be long term gains or it could be short term gains. Then on top of that, if still have any more losses up to $3,000, you can adjust with your W2 income or a business income. Still, if you have any more losses, those losses will be carried over to the future period. It never expires. So before December 31st, if you have any stock which are lost, which are in the losses, if you're in the red color, try to sell those stock and book the losses and those losses can be adjusted either this year or any time in the future. But if you are but if you are trying to but if you are trying to book any capital gains, already have some capital gains this year, then definitely consider tax loss harvesting, about selling your stock when they are in the losses. But very important point, you cannot buy the same stock within 30 days after you sell the stock. Otherwise, wash sale rule is applicable. So, and these all are for regular stock portfolio. If you have investments in crypto, whenever the market is down, it could be an opportunity for you to sell those cryptocurrencies and book the losses. And the beauty here is wash sale rules are not applicable for crypto. It means you can buy the same crypto coins immediately, even when they, because there is no wash sale rule. So, so before December 31st, whenever if you have investments in the stock market in the cryptocurrency, whenever the market is down, try to sell it, book the losses, buy back immediately. That is for the cryptocurrency. And the other very important point which I want to talk here is number one, strategy number one, offset gains and losses. If you have any capital gains this year, before December 31st, you can sell any stock. It could be short term or long term. Long term gains or short term gains can adjust with short term gains or long term gains. So short term losses or long term losses. So the criteria is, if we have some losses, those losses, the on first priority gets adjusted, tries to gets adjusted with the long term gains. After that, it goes to the short term gains, because short term capital gain tax rates are higher. So play this game before December 31st. Definitely you can save a lot of taxes. Then properly, the strategy number two, properly use long term losses. It means if you have long term loss of $3,000, as I mentioned, you can adjust long term losses or short term losses up to $3,000 with your ordinary income. At the same time, any losses, long term losses, can be adjusted with your short term gains. This year, because of the political scenarios, the stock market is very much volatile, and I know many of you have booked good, decent size of capital gains. So before December 31st, try to book some capital losses so you can optimize your tax bill. Avoid the strategy number three, avoid cash wash sale rule. What does it mean? Whenever you're selling a stock with losses, you cannot buy the same stock within 30 days. If you're buying it, that losses whatever you captured will not be helpful for you, but rather it gets adjusted with the base price. So just be very careful about the wash sale rule whenever you are selling the stock in losses. Then strategy number four, make use of lower tax brackets. If you are familiar, we have long-term capital gain tax rates have three buckets. Number one, if you're married filing jointly, if your total income, including long-term capital gains, is less than $96,700, your tax rate is zero. You don't need to pay taxes at all. If you're a single, not a married, if you're single, then it is $48,350. If your total married filing joint income is less than 600,500, then your tax rate is 15%, 1 5. And if your income is more than $600,550 for the married filing jointly, your tax rate is 20%. So what we understand, if you have lower incomes, your capital gain tax rates are lower. If you have some appreciated stock, try to gift them to your family members. It could be for your parents, it could be for your kids. And if they sell the stock, they might be at a lower tax brackets if you are at higher tax brackets. But please note, there are some gift tax rules are there. If the gift amount is less than $19,000, you are happy. If it's more than $19,000, you need to file gift tax return, which could impact your estate tax planning. So be careful, be cautious when you are implementing these strategies. Strategy 5: donate appreciated stock to charity. What does it mean? Before, if you are filing an itemized tax return, you if you're filing an itemized tax return, whatever charity donations you are doing to a 501c3 organizations, you get a tax deduction only if you are filing itemized. Generally, we all donate to non-profits in cash. Rather, you can also donate in appreciated stock also. There are some advantages when you donate appreciated stock. Like example, if you work for a corporate, if you are having an RSU stock, you have appreciated value of the stock. If you are donating those stock, then you can get a tax deduction at the fair market value on the day of donation. If you are selling the stock directly, then you need to pay taxes. The balance amount you can donate. But rather, if you are donating directly to the non-profits, 501c organization, for 501c3 organizations, then you can enjoy the tax deductions at the fair market value. And the non-profit organization, whenever they sell those stock, they don't need to pay any capital gain taxes at all. The last one is don't donate stock losses to the charity. I understand in my earlier strategy, I said donate appreciated stock. If you have any loss making stocks, don't donate to non-profits. Because if your loss making stocks are there, unrealized losses are there, I want you to sell the stock, book those losses, and even you are not able to use those losses immediately, you might be able, you will be able to carry over those losses to the future period. Sell the stock, and and whatever the money you are receiving, after that you can do the donations. So at high level, these are the 6 strategies which I would like to talk for today. And tomorrow I will come up with some new topic every day, just 10 minutes. Let's focus on learning something. Get into the habit of learning every day for 10 minutes. That's 10-minute step for today. And thank you very much. Good night. Bye.